Good morning. I'm Randy Barkley, and I'm here with Jeremiah Lee. And every week we're talking about some of the key financial choices, and hopefully it's beneficial to you listening.
Yeah, Randy and I are both certified financial planners, and I'm also a California licensed attorney. We work together. We work at Tricord Advisors, and we help clients as they kind of build their life they love.
You know, the discussion that we want to talk about today, we've had a lot of discussion over the last couple months about this. The market has recovered a lot. Is the stock market? Are we? I guess the question is, are we in a bear market rally, or are stocks undervalued? Is this just a continuation of the bull market that we got through to January, and we have this pause? And the question is how do investors know?
Yeah, I mean, we're here the second week of August, and we have had a great week. I mean, for most of the stock market,
Right.
And last week was pretty good too. So the question that a lot of people are having is what did we see a bottom last week, or did we pass it and we're zipping back up, or are things still way overpriced? And so, kind of what we're talking about today is how do you price stocks? How do you know?
How do you value, right?
Yeah, how do you value a stock? I mean, what is it actually worth? You know, home prices. There's always these comparisons of what it might be, and you can look on Zillow and Redfin. And there's people who do that in the stock market. They value prices, but the big difference with the real estate is if you come in, someone comes in the day after you buy your home and says, "Hey, I want to buy your home for half that price." You just say, "That guy's crazy, go away." Whereas if
Right.
so that happens in the stock market, people say, "Oh no, what have I done? I bought the wrong stock," just because you see the price change. So there's an intrinsic value in stocks, but how do you get to what that is? And if the market's just blowing smoke.
Yeah, I think again the marketplace, the stock market is substantially more liquid, and there's a lot more players into it. For example, if you buy or sell your home, you have very few buyers, you have very few participants. You have the seller and maybe a few buyers. But if you have a stock, if you're dealing with a large public company, you could literally have thousands, if not millions, of buys and sells,
Yeah.
all within a very, very short period of time. So the market is they're looking for dislocation. And well, that's another subject matter. Valuations really come down to some key factors, but kind of a caveat here or a disclosure that most valuation models are for looking at a very long-term hold, typically like 10 years. And so when people look at a stock and they see the market going up and down within a week or a month or even a year, they're saying, well, the stock must not have the value. It must be worth less than what I paid for it.
Yeah.
In actuality, it may or may not be that true. It may not be that case at all.
Yeah. So what we want to talk about a little bit is these ideas. So let's just jump into a few of them. So price to earnings is probably the most common or most well-known
Right.
metric. Is you take the price of the stock as compared to that company's earnings, what the company actually produces, and you have a ratio. Those ratios, in the
Right.
worst of times have been 10 to 12 times. In the best of times, they've been 24 times or so. In recent history, we had 21. That was the kind of the high that people were saying a while ago, saying, "Hey, these are really high." And of course, that's an average. I mean, each stock is
Right.
unique. But right now, we're kind of at 17. So the question being, okay, is a 17 price to earnings? It's the price you have to pay compared to the earnings they make.
And that's the average. That's the average, right? I mean, we're talking about all.
That's the S&P in the recent history, in the recent days.
Right.
So is that enough? Is that okay? Is that overvalued or undervalued? And the hard part is historically you'll look back and that still seems a little bit high. But in recent history, that seems low. It seems lower than what it was.
And I think a lot of the evaluators bring in the cost of money. In other words, interest rates being artificially low. As the Federal Reserve starts to increase interest rates, it's starting to have a more impact, particularly for those companies that are the growth companies. Higher interest rates will kind of discount their value, and we've seen that happening. All of a sudden we were talking about, it seems like a long time ago, but it was really only the first of the year that most economists, most analysts were talking about the Federal Reserve increasing, the discount window, the long-term, the aspect of what the Federal Reserve controls by 25 basis points for a fourth of a point. But what they did is they went from 25 basis points to 75 basis points, which is 3 times more as far as raising the interest rates. And that roiled the markets. I mean, it affected bonds, it affected stocks, it had a major impact. And now we're looking at, as inflation kind of tamed a little bit, and the prospect for them to continue on the same trend to raise interest rates in subsequent meetings, has started to become a little bit muted. I mean, there's anticipation, right?
Yeah, well, and that shift should change markets. When people are looking ahead to say, what kind of earnings will this company make, and how do I value those? To current,
Right.
if the Fed's change in interest rates is that extreme, it should change markets. And I think it's not surprising to me when you see that volatility. The other aspect that we're in, that's just not a valuation model, but we are in a season of high volatility. It used to be that volatility, there's a VIX, it's one measure of it, was between 10 to 12 on their scale. 10 to 12 was the normal volatility. Well, we have been above 20 and even reaching up to 30 at times.
This is basically the first of the year, right? I mean, we've been above.
Yeah, 20. Even before that, all of COVID, we've been really high. And there's people who thought, oh, this will come down, it will renormalize. Well, it hasn't yet. And so we are still in some significant high volatility, but people are just kind of getting used to that. So the question that people often have, that we have, is, will this be a new normal? And we just get used to having volatility at 18 or so? Or is this something that will come down back to normal? Because there's a number of people who would say, just pull the money out. It's too volatile. There's no reason to be invested when the volatility is this high. But they may miss the next 4 years, say, before we get back to kind of a more normalized volatility.
Yeah, and I think there's a lot of people that have valuation models that they follow. For example, Warren Buffett has a valuation model that it's been well touted. But it's kind of interesting. Warren Buffett has ample cash, but he's not exited stocks. I mean, the companies that he owns, he hasn't sold them off. He's not concerned about, their long-term growth pattern. If you had Warren Buffett sitting in the room with you, he doesn't make decisions based upon what goes on today.
Right.
He makes decisions based upon what he thinks is going to happen over the long term. And investors should be that way, right?
Yeah, and neither should anyone listening. Neither should we. We shouldn't be looking at what happened today to make a knee-jerk reaction. And the Buffett ratio, as they call it, is the total market, the equity, and add up all the different companies, all the market capitalization. You add all that up, and you take that by the country's GDP, gross domestic product. It's very similar to saying the price to earnings. It's a similar type structure.
He's taken a much more, I would say, global perspective on that. But he's saying, like, all stocks are as big a basket of stocks as he can take, right?
Yep. Yeah, to say, okay, are we at a good spot or a bad spot? Another one that I like is, in harder times, you have what's called the price to book ratio. This is kind of an accounting term that you have, price to earnings. So it's the price that's in the market compared to the earnings of the company. Whereas the price to book is the price of the company compared to what they're carrying on their books for all their assets. So they have some buildings, some vehicles, all the different assets they have that carry on their books. This should be a much lower number.
I mean, if you're an accountant, if you want to dig deep into the all the financials and to come up with that, it's a pretty complex calculation.
Yeah, and for most people, this is the basement. This is the very lowest to say, how much are you trading worth? How much are you trading relative to how many assets do you have? And if it goes the other direction, that your price is lower than all your assets, that's where you hear people talk like a fire sale. Someone will come in and buy up the company and chop it up and sell off all the pieces, because they say, each piece, we know they add up to this much value, but as a whole, you're trading much less. So for a lot of folks, this is a basement price, but it's one way to get at kind of another way to value it. But it's hard because this doesn't really apply to, say, tech companies. Their assets are not on machinery and equipment. It's in this intellectual property, which is still valued, of course, but it's just a little different.
Like a dividend yield would be, it doesn't apply to a tech company typically.
That's right.
Because the companies that don't pay a dividend out, that's why rising interest rates really have a profound effect on companies like that, whereas those companies that are paying a dividend out, but again, that dividend yield has a major impact upon companies that aren't paying a dividend.
Yeah, that's right. Yeah, dividend yield is the dividend that's paid out every month compared to the price of the stock, like how much you're actually getting for that. And that's another evaluation, is kind of more looking at the person, I would say, like what's going to land in my pocket. Like, forget how the company's doing, forget how well they're operating, but what am I going to get from this stock? What's the stream of payments that's going to come to me? And that helps determine what it's worth.
And I think the most common one, that one's the most touted as far as published in the Wall Street Journal and such, is the CAPE ratio. Now, this was developed by Nobel Prize winner Robert Shiller, but he talks about the ratio, or the average price of a stock going back historically. And he goes back all the way to 1900. And he says, typically whereas the stock prices have been in relationship. But even if you dig deep into his analogies, you dig down deep, he doesn't exit stocks based upon his analogies. I mean,
Mm.
he'll reduce his equity positions, but he's still going to have a large position within stocks because even he recognizes there's more forces affecting the valuation of a stock or the market value of a stock than just what's going on for the moment, I guess is what I'm saying.
I think it's a really good comment for ourselves and our clients. As we walk through this, it's very seldom that we are exiting things entirely.
Right.
It's very seldom that we say we're walking away, we're selling. And people, as they hear a song, they could feel that idea. Oh, I got to get out of this or get into this. And that's what you hear in my mind on the radio a lot or on the talking heads. You got to get out of this. You got to get all into this.
Well, again, it's the panic pushers, I call them.
Oh, there you go. Yeah.
They're selling a product. They're selling something, whether it be annuities or gold or silver or something tangible, real estate. You see a lot of real estate stuff that's in the marketplace. And it's the panic pushers. And they're saying inflation has run away. And in order to protect yourself from inflation, stocks aren't going to protect you. So therefore, you've got to be in these particular entities or commodities or whatever these vehicles.
Yeah, and with that, we like I said, we seldom fully exit things. We trim,
right?
We adjust, we modify, and so do so many other money managers. Is they want to keep you in a portfolio that makes sense for your finances, makes sense for your future life. But it's not saying, oh, Google had a bad day, sell all of Google. They might say, oh, Google is doing great. Let's trim that position and get out of some of it. Google's having a rough day. Hey, we know they're a good long-term stock. Let's buy more. It's kind of like counter-cyclical adjustments to the portfolio.
Yeah, I mean, the conversation that we have oftentimes with clients or prospective clients is they'll make a comment and they'll say, they say that. And they'll refer to, like, or we're going to have a recession. Because that's probably the key word that's being touted right now in the news. You talk about economic news or what you read and such, that recession is a big, big factor. Inflation is a big, big factor. And what they're not taking into account is what the individual companies and how they're responding to that. I mean, not every company is going to be affected negatively by recession or as negative as some other companies, even within the same sectors. So you have to really break it out, right?
Yeah, and I always love it when we're in a meeting and someone's saying, oh, they say this, they say that. And sometimes you'll stop. It's like, well, who is saying this?
Who's they?
Is it your buddy Bill at the water cooler who you don't think is that bright anyways? Or is it someone you heard on the radio? Is it a family friend? Is it someone who you really respect, some economist you're listening to? You have to kind of judge that news because in our day and age, we get inundated with input. It could be Instagram, Facebook, the regular news, wherever you're getting it from. You're inundated with information, and we have to, as humans in this day and age, we have to process it way more, I feel like, than we did previously, not just be overwhelmed by the amount of times we hear the word recession. I've seen news articles where news stories, segments where no one actually said it was a recession. They just mentioned recession, 10 times. And therefore I walk away feeling recession, even though nobody said there was one. And it's an interesting, there's some issues with that anyways, but it's interesting how much we pick up stuff and grab onto it.
Right.
We really need to consider the source.
Yeah, I think that we're continually looking at information. And again, I always go back to just the facts, ma'am. And we want to analyze, first of all, what is a reasonable holding. I don't want to buy something that's overvalued. And a lot of these entities that we've referred to here, they're analysts. I mean, they're looking at the economics. They're looking at it and say, historically, what's the price of something? And again, I don't want to be buying something that is at the high. I want to be buying something at the low. But timing the marketplace, that's where most people don't realize it is really difficult to time a stock. It's really difficult to time a portfolio to say this is the best time to buy it, this is the best time to sell it. And the best of minds have tried, and the best of minds have lost out on that. They just haven't been able to accomplish it because the market does what the market does. Right. And again, you have several factors.
Yeah, but people take a long-term approach.
Right.
It's not the knee-jerk reaction. It's not in and out. It's not trying to time it. It's just saying this is good value. Let's buy it for the long term. If anyone has a topic they want to hear us talk about in the future, feel free to go to our website, retirementunlimited.com. Use the comment section. You can send us a note or give our office a call. It's 951-684-7011.